Josh, what I'd like to do is, I'm Bill Bullard. I'm CEO of RCAF USA, and I'm here helping the TAPS group in promoting the comprehensive reforms that they're recommending for the cattle industry. And what I want to do is I want to go back just over a generation, and I'm going to call it a generation. It's some 40 some years back to 1980. And back to 1980, we must presume that we had a competitive marketplace. This was before the high concentration in the industry. We had 1.3 million cattle operations in the United States. We had over almost 1,500 federally inspected meat plants. We had a robust industry back then. And so back then, we relied upon competitive market forces to properly allocate every consumer expenditure for beef. So a consumer went to the grocery store, bought a roast, and the competitive forces in the marketplace would allocate the revenues from that roast all the way upstream through the multi-segmented beef and cattle supply chains, and they would deliver the competitive allocation to each of those segments based on their contribution to the product. So we go back a generation ago, and for every dollar a consumer spent on beef, we're looking at the chart on the left, the pie chart on the left. For every dollar that a consumer spent on beef, over 60 cents of that dollar flowed through the beef and retail, the packing industry, and to the live cattle segment. So the live cattle producers, cow-calf producers, backgrounders, and feedlots were sharing over 60 cents of every consumer dollar back in a generation ago. The retailer, the packer, were receiving less than 40 cents of every dollar. And that certainly made sense in the competitive marketplace because obviously the live cattle segment requires the most management and time and resources to grow the animal to where it's ready for the meat packer to slaughter. The meat packer keeps it for a week or so and passes it on to the retailer for sale to the consumer. So it made sense back then. But we jump ahead now to 2021, which is the data I have on the chart. 2021, that was completely reversed. In 2021, the producers in the live cattle segment had to share less than 40 cents of every dollar, and the packer and retailer were capturing 60 cents of every dollar. Now, there's no regulations or laws that prescribe the allocation of that consumer dollar. We rely upon the invisible hand of competition to do that in a multi-segmented beef supply chain and cattle supply chain as we have. So in the course of one generation, we completely reversed the allocation of the consumer beef dollar. And now we see the retailer and packer capturing the lion's share of that and the live cattle industry receiving a minority share. The question is, in a competitive marketplace, how can that happen? How can you have such a radical change in the competitive allocation of the consumer beef dollar in the course of just a generation in a competitive marketplace? How can that happen? And the answer is it can't. It can't happen in a competitive marketplace. And so something else has affected and impacted and intervened in order to allow the meat packers and the retailers to capture the majority share from the producer. What I'm showing you now is the impact of that, and it's stark after 2000 and into 2014. What this chart depicts is the blue graph represents the monthly price of beef that consumers pay for in the grocery store. The red line represents live cattle prices. And you can see from 2010 through 2014, there was a harmonious relationship between live cattle prices and consumers' purchasing prices at the grocery store. That made sense. The only ingredient in beef is cattle. And throughout history, we go back long before 2010, we see this synchronous, harmonious relationship where there's a very small spread between the live cattle price and the retail price. Now, at the end of 2014, and this was following the widespread drought, 2011 through 13, all of the experts predicted that cattle producers, cow-calf producers in Iowa and elsewhere, would continue to receive high prices for the cattle for 3 more years. That meant all the way through 2018. And that's a function of the long biological cycle of cattle. It takes 3 years to rebuild a liquidated cattle herd in order to increase production. So that was the promise, the expectations back in the end of 2014. But something happened. In 2015, cattle prices inexplicably collapsed. They collapsed further and faster than at any time in history. They collapsed for over a year's time, didn't settle until October 2016. When cattle prices collapsed, retail beef prices for the first 8 months continued to increase. And then they too subsided somewhat. And then at the end of 2016, cattle prices started to rally. And so too did consumers' willingness to pay for beef begin to rally. So from 2017 through 2021, we saw this inverse relationship with retail beef prices rising to superinflated levels and cattle prices stair-stepping downward. And every time cattle prices tried to recover, there'd be a turnaround, we'd have a collapse in prices, and each peak was lower than the peak before. So we went through multiple years where cattle prices were declining, retail beef prices were increasing. What this chart depicts is that producers on one end of the supply chain and consumers on the other are both being exploited. And we see that for an 8-9 year period, we've never seen the spread between live cattle prices and retail beef prices like what we've seen since the beginning of 2013. So we have to ask, how did this happen and what is necessary to correct it? And we have to look at the state of the U.S. cattle industry today. We have a competitive infrastructure that consists of producers, the mother cow herd, and marketing outlets that must be sustained, or we're going to hit a point of no return. We have to have participants, we have to have mother cows, we have to have marketing outlets. We're looking now at what has happened to the participants in the industry. This goes back a generation ago. We had 1.3 million cattle producers scattered all across the United States. Latest census data tells us that we've lost over 544,000. Over 500,000 independent producers have exited the industry in the course of a generation. In the middle of the chart, I've got where we entered the North American Free Trade Agreement. When we did that, the promise and expectation was we would increase U.S. beef access abroad, we would increase beef demand, and as a result of those two factors, we would bring prosperity to the U.S. cattle industry. Obviously, that did not curb the ongoing decline in the number of producers. And if you look at this chart, you can see there's a downward trend line. We can predict the future. If we don't make any changes, we know what's going to happen with the participants in the industry. They're going to continue dropping like flies. Now we look at the second element or component of our competitive infrastructure, the size of our mother cow herd. That's our factory. This goes back just a little longer than a generation when we had a herd size of over 45 million mother cows. But you can see that over the course of this generation, we have been reducing the size of our herd. This cannot be a function of drought, because we have not had drought throughout this entire period. Other factors have to be intervening. This chart too is a downward, alarming downward trajectory, and which indicates to us if we make no changes in the framework within which our industry operates, we're going to continue to see a decline in the number of cattle in our herd. In the middle of the chart, again, we entered North American Free Trade Agreement. This was our globalization effort. This was our solution to the agricultural problem: increase exports abroad, increase demand for the product, bring prosperity to the industry. We have been declining. In fact, our herd size is about 4.5 million head less today than it was back when we first entered the North American Free Trade Agreement. What this chart depicts is that the North American Free Trade Agreement did not accomplish what we were promised, and instead it has, if anything, accelerated the decline of our industry. Now I'm showing you, since NAFTA, the number of marketing outlets available to your cow-calf producers and your backgrounders. These are the feedlots in the United States. And we had over 113,000 feedlots scattered across the United States just back in the mid-1990s. Today, we wiped out 75% of those. There's only about 27,000 feedlots left. The feedlots that we lost were the small independent cattle feeders that you have scattered all across Iowa. They've been dropping like flies. And what this means is now there's fewer potential buyers for cow-calf producers. And as a result, there's less competition in our industry. So these three components of the competitive infrastructure that are essential to sustain a competitive industry are all facing downward trends, long-term downward trends, not attributable to some isolated drought, but rather to some structural failures within the industry, market failure within the industry. And then we look at the producers themselves. We look at the cow-calf producers. USDA keeps data on the returns to cow-calf producers per bred cow. And we see that during the same period, we are on a sharp downward trend line, that the returns to cow-calf producers have been declining over time. You can see that there was an adjustment in 2014-15. That's when the market shock created by the drought was so severe as it unleashed the latent competitive forces in the marketplace, and cow-calf producers saw a temporary reprieve to these long-term downward trend lines. Again, can predict the future if we make no changes. USDA also keeps data on the returns to cattle feeding in the United States. And so here's 22 years worth of monthly data based on USDA's own reports on the returns to feeding cattle in the United States of America. The dark dotted line is a trend line. You can see that intuitively that there have been more losses than profits in the cattle feeding sector. And in fact, if you average the losses for this 22-year period on a monthly basis, it's a loss of over $27 per head per month for an entire 22 years. Now that answers the question why our independent farmer feeders are dropping like flies. It doesn't explain why the largest of feedlots, we have 77 feedlots that feed over 1/3 of all the cattle harvested in the United States. And those feedlots continue to expand, continue to grow, while the independent feedlot is dropping like flies. So this explains why we're losing feedlots. It doesn't explain why we even have a viable feedlot sector left in the United States of America. How can that be possible if the average loss is $27 per head per month for 22 years? And the answer to that is there are procurement practices underway in our industry that are giving preferential treatment to some of the largest feedlots that the independent feedlots are deprived of. And as a result, they're faced with the vagaries of the marketplaces that is continually returning to them less than their cost of production. So we see that we are losing our competitive infrastructure at an alarming rate. We can see that the economic viability of participants in the cattle industry is shrinking and contracting at an alarming rate, and something has to change. This chart merely shows that what the pie chart depicted. Because back in 1980, a generation ago, we had 63 cents went to the producers of the cattle and 37 cents went to the meat packer and retailer. And now today, 2021, we were at an all-time low, and that's when there was a complete reversal. Again, you see this reprieve in the latter 3/4 of the chart, and that's when we were, impacted by the economic shock of a widespread drought. The latent competitive forces were unleashed, and the cow-calf producers were suddenly receiving over 50 cents of every consumer beef dollar. But that was very temporary. As soon as the drought was over, we reverted back to this structurally broken marketplace that would not return cost of production to producers. We look at trade flows. I'm showing you here 30 years, annual years of trade balance with Canada and Mexico in the trade of cattle and beef. And you can, the maroon graph there represents our exports of US beef and cattle to Canada and Mexico. And you can see that we've had some increases and decreases over time. But over the course of this 30 years, we've doubled our exports to these two countries. But while we doubled our exports, we've also significantly increased our imports to where we are now exporting about 1/3 of what we are importing from these two countries, leaving us awash in a trade deficit. So this is just with US-Mexico-Canada agreement, formerly NAFTA. This is the trade that we are experiencing with Canada and Mexico. Significant to this is the entire industry calls these our most important trading partners. We have to maintain trade with Canada and Mexico because it's vital to the economic viability of the US cattle industry. When in fact, as a result of the trade deficit that we annually accumulate with these two countries, we are burdening the US cattle industry and reducing demand for domestic cattle. We look on a worldwide basis. This is the same chart, same time period. The maroon represents exports of US beef abroad. You can see in the middle of the chart, our exports fell to a 19-year low due to the BSE situation, but they've been increasing ever since. 2021, we had record exports, and these exports continue to be overshadowed by record imports as a result. So we have consistently maintained a trade deficit in volume. We are a net beef importer, and as a result, we are burdening the US cattle industry. We are reducing demand for domestic cattle, and cattle producers are suffering. So how do we fix this? Well, we know what has happened is we purged competition from the industry. We have to reignite competition, and where you do that in every other sector of the economy is you focus on the consumer. The consumer, by virtue of its choices and preferences exhibited in the retail market, determine where the supply chain must source the beef and cattle in order to satisfy consumer demand. We need consumers to be able to distinguish between the high quality USA product versus the cheaper product that's coming in from 20 different countries: Uruguay, Australia, New Zealand, Costa Rica, Nicaragua, Honduras, Namibia, Africa, Mexico, Canada. We import from 20 different countries. Consumers can't tell the difference. So they are unable to initiate a demand signal that would flow through the packers and tell the packers where they have to source their cattle in order to satisfy this generic demand. Right now, packers have unilateral authority. Consumer buys steak in the grocery store. The packer can choose from any of these 20 countries from where to source that, the cattle and or the beef, to satisfy that consumer demand. We must have mandatory country of origin labeling in order for consumers to be empowered to initiate demand signals that flow upstream in our supply chain and restore competition to the marketplace. And once we've reinserted competition in the marketplace, we have to force these multinational meat packers to compete in the cattle market. We have 4 packers controlling 85% of the market, and they have introduced, as I said, procurement tools in order to gain a leverage over the marketplace. But the most egregious of those are these forward or formula contracts that are tied to the residual cash market. The packers incentivized to reduce the value of cattle in the cash market. All they have to do is shun the market in order to reduce competition. They lower the price in the cash market. As a result, they buy all their cattle cheaper because all of their forward formula contracts are tied to this residual cash market that is too thin in order to determine or establish a competitive price for cattle. We also need to end this price distorting trade imbalances that are based on a faulty theory. The faulty theory, of course, was you increase export abroad, increase beef demand, that will automatically bring prosperity to the cattle industry. That has been an abject theoretical failure, and we've got to move away from that. And then we have this issue of inappropriate industry promotion, where U.S. producers are paying into a checkoff, and the checkoff is out abroad selling U.S. beef with a checkoff logo. In the United States, you can't market your beef as U.S. beef. It can only be generic beef. So U.S. producers are paying for their competitors' advertisement and promotion. And by doing so, by not distinguishing the unique attributes of USA beef produced under the highest standards in the world, because we do not do that, we're actually lowering the value that consumers perceive of beef for U.S. cattle producers, and it's harming the producers. So in a priority sense, the first thing we need to do is restore mandatory country of origin labeling for beef, so that when consumers go to the grocery store, they can choose to support the domestic supply chain, and they can choose it for a variety of reasons, because they want the beef produced under the highest standards in the world. They may be concerned about a foreign country like Brazil that has a history of adulterated meat products they're trying to export. Consumers deserve to have the choice to know where the beef comes from. Second things we need to do is we need to force the packers to begin actually competing in the marketplace. And we proposed initially to triage. The first thing you do to force the packers to compete is make them compete. They compete in the cash market, force them to compete for at least half their cattle needs in the cash market. We're now dealing with a compromise bill, the Fisher-Grassley bill, that provides no certainty whatsoever as to what the USDA will do over time. And certainly it is inappropriate based on the urgency associated with the ongoing contraction of this industry. We have producers dropping like flies. We have feedlots dropping like flies. We do not know, we can't quantitatively describe the number of producers we've lost in just the last couple of years, but we know it's significant. Then we need to address those practices that we know are occurring between the packer and those largest feedlots. How is it those largest feedlots are expanding at a time when independent producers are falling away, or falling aside by like flies? Well, we know these alternative marketing arrangements tied to the residual cash market are one culprit. Another is the packer feeding and control of cattle that allow them to shun the cash market. And then we have this issue of bonuses. We have an academic study report now that says that the meat packers are giving bonuses that are in addition to the market value of cattle that's reported to the USDA. In other words, not based on the quality of the animal. There are bonuses out there based on the volume of cattle delivered to the packer throughout the year, for example. We also know that there's cost sharing type arrangements out there, financial agreements that are giving distinct economic advantages to the largest of feedlots, while all other feedlot operations are being deprived. So that, in a nutshell, covers the urgency associated with the 2023 Farm Bill. It also highlights the need for what the TAPS group is doing, and that is promoting a comprehensive omnibus package that will reform the industry. It will restore mandatory country of origin labeling. It will eliminate the anti-competitive procurement practices that we know exist in the marketplace. And there are now academic studies that support our contention here. And it will expand packer capacity. After we went through merger mania in the 80s, we do need more capacity. But we first have to address the anti-competitive practices in the marketplace. We have to address the ongoing merger mania that's occurring, and the AMP Act addresses that. And it addresses even more issues. It addresses the foreign ownership of US processing plants, for example. So it's an omnibus package, and what they did was they went back and they took the legislation that had been introduced for the past 20 years, was never passed, never saw the light of day in many instances, and they revised that based on cow-calf issues and concerns and put it together in the AMP Act. So with that, I'm going to stop unless there's any questions and turn it back over to Angie or Chuck. So thank you.
Thanks for that. One quick question, just getting your thoughts, and maybe you have data about it. You talked about the 63% of every dollar used to be with producer, now it's with the packer retailer. Do you know the percentages between, is it more the packer side of things or more the retailer side of things that's causing the disparity? Okay.
More the retailer. The retailer has captured the greatest percentage of that increase.
And what's like a good resolution for that? Because I've heard the same thing in terms of the retailers. Of course, there's mass consolidation in the retail space as well. So I'm just curious if you have thoughts on best practices to address that issue, or
yeah. So the best practices are to address where we know with data that the marketplace is being leveraged down by the packers when they procure cattle from the live cattle supply chain. The packers and the retailers are essentially working in unison. As packer profits increase, so too do retailers. If the packers were forced to compete, they would then compete for cattle. They would then be forced to compete with the meat pack or with the retailers. And so we have some of the same type of procurement practices on the retail side. We have long-term contracts, short-term, we have a spot market, and we have long-term commitments to some of these meatpacking entities. And as long as they can maximize their profits by purchasing cattle at a lower price, they'll play that game. So we need to reform the entire industry, but we need a starting point. And the starting point is where the cattle producer, the largest segment of American agriculture, is being exploited by the four packers. That's where the bottleneck is. And there's no question about it. There's also problems downstream to the retailer, but that's beyond what cattle producers are able to address at this point.
Okay, thank you.
Josh, or Bill, I might add, I guess. My name is Mike Schultz. I'm from Northwest Kansas, cow-calf producer. Josh, your counterpart in the country there, Eric Nelson, who's on the board with RCAF with us, is a really good guy. We've appreciated working with Senator Grassley in the past too. So I think a lot of the stuff you're going to hear about, if you check with them, you'll find out that it's positive. I chair the Cool Committee for RCAF. And I don't know if you've seen recently, but March 6th, they came out with a labeling deal for product of the USA through USDA. Did you see that report?
I did see that, yeah.
Okay, well, if you've had time to read it, the November 30th report in 2022 basically showed that about 64% of the people were misled by USDA labels or labels that they didn't understand. And the misnomer and the issue we fight is that they said people would be unwilling to pay for product of the USA, when in fact, I believe in the report for a ribeye, they were willing to pay like $1.34 more a pound if they knew it was a product of the USA. We're big supporters of the product of the USA label. In the AMP Act, it has a bill called the American Beef Labeling Act. that addresses any issues that you would have or might raise with the WTO. Currently, the WTO is in disarray, and the appellate panel that ruled against us is not put together right now. It's been out of order for about 3 years. So if we pass a new law, the American Beef Labeling Act, there's a bona fide beef labeling law out there, but it's got voluntary in it. Gosh, we can't have voluntary. We've got voluntary today and it fails. We've got a guy that serves with us who is one of the largest beef procurement buyers through all the meat packers. He works for a big, huge retail segment now. They have retailers who bring in Australian imported beef that's not labeled, and they have grocers that want to put a product of the USA label on it and sell it to consumers. That's wrong. It's fraudulent, and it shouldn't. And he tells them they can't do it. They shouldn't do it, but there's no law to prevent it. And so we need some teeth in this thing. That's why we believe the AMP Act is the best method to get there. What Bill talked about addresses a lot of those issues. And I would hope to see that you guys would get some support behind us with that. I shared this week with the Kansas Senator and Representative Roger Marshall and Tracy Mann about the Silicon Valley Bank issue. People knew that was going to go on, and they failed to do anything about it. That's where the cattle industry's been. We've been trying to tell people we need to fix this deal. We've lost our cow herd. We're in a disarray in the cattle industry because of anti-competitive markets. So we need some help, and we'd be willing to work with you, provide you more information, to get that done.
Okay. Well, I appreciate that. And yeah, feel free to continue to reach out going forward. And yeah, obviously Tracy Mann is a good person to have in your corner and to touch base with, since he chairs the livestock subcommittee. But yeah, feel free, happy to keep discussions on these issues. And like you said, the producers up in Northwest Iowa we hear from them all the time. So we care about these issues as well. So yeah, feel free to continue reaching out. Happy to stay in touch on these issues. And if there's ever anything that pops up regulatory wise or bill wise, just flag it for me and we can kind of work from there.
Can I share one little item with you real quick? Is that the NCBA is the workhorse against us with our checkoff money. That's where they're funded. But you have to understand they represent about 0.00466% of the cattle producers. If there's 750,000 producers and they have 33,000 members, a lot of people don't belong to anything because of the fight. So please remember that as you go forward.
Okay.
We're telling you what consumers and real producers want. Okay.
Okay. All right. Well, I appreciate this background, and you have my contact now, so feel free to keep touching base as we move forward.
This is Chuck Gabbard. Thank you for joining us today.
Yeah, thank you. I appreciate it.
I'm the founder of the TAPS Group, and I'd like to recap for you briefly some of our concerns. We are in 25 states right now. We started in Texas, and we're in Iowa, and we have a good group there. We're really concerned about the 17,000 plus producers going broke every year, going out of business. And there's only one reason for that. There's just one reason for that. And that's because of ineffective legislation and ineffective congressmen and senators. They're not doing their jobs. We have found that most people that we talk to when we have Zoom calls like this, and we ask them if they know what's going on today in the beef industry, they tell us, of course we do. We talk to NCBA. We go to their conventions. We listen to their lobbyists. And that's the reason they don't know what's going on today. They do not go out and talk to the people in rural America, the people that are losing their cattle, or losing their jobs, or losing their livelihood. Rural America is being hollowed out because of the ineffective government that we have right now that are not enforcing the laws that are on the books. We have a fraudulent situation right now where when beef comes into the beef packers, they can take the label off, throw it in the trash can, and put product of USA on it and misrepresent what that is and conceive the misinterpret what's going on to the American public. And then also the violations of the antitrust laws, the Packers and Stockyards Act. You know, nobody's dealing with any of this. And what we have found is that over the last 10 years, 20 years, that nothing has been done. So that's why we did the omnibus bill, the AMP Act, because we think that that's the only way to get something accomplished. And we hope you'll take a look at that. Angie was asking if you have a copy of that. Do you know if you do or not?
I don't think I do. Feel free to send that over, and I can do some digging there and talk to Tracy Mann's staff about it as well.
Yeah.
But yeah, I will look into that.
We sure appreciate, you know, you listening to us, but we're very adamant about this in our group because nothing has been done, and people, like Bill said, are dropping like flies out here. The people that are prospering are the Packers and the big feedlots. We're the cow-calf producers. We're the ones that sell them the product that they are making the profits on, and we're out here going broke. So we need some help.
Okay. Well, I appreciate it, guys. I apologize. I got to hop off to
Thank
another call, but I appreciate it.
Thank you,
Thank you,
Josh.
Josh.
Yep.
I'll
Thank
be in
you.
touch.
Sounds good.
All right.
Bye.
Have a good day. Bye.